Good day. I'm Todd Sankowitz along with Joe Castiglie from Psychon Capital. It's an honor to introduce our esteemed guest, Shlomo Benartzi, an esteemed leading figure in the field of behavioral finance and economics. At Psychon Capital, we're trying to revolutionize the wealth management experience by integrating advanced technology and behavioral finance to align with investment strategies and clients' core values and unique financial behaviors. We're dedicated to bringing innovative solutions to clients, and today's discussion promises to offer valuable perspectives on combining psychology and economics to address critical societal challenges. Shlomo is a prominent figure at the intersection of behavioral economics and finance. With a PhD from Cornell University's Johnson Graduate School of Management, our guest has dedicated their career to applying the insights of psychology and economics to address significant societal challenges. As a professor emeritus and co-founder of the Behavioral Decision-Making Group at UCLA Anderson School of Management, he's played a pivotal role in advancing our understanding of human behavior in the realm of financial decision-making. His groundbreaking work alongside Nobel laureate Richard Thaler on the Saving More Tomorrow program has had a profound impact on increasing employee savings rates. This program has not only transformed the financial well-being of countless individuals, but also influenced legislation with its incorporation into the Pension Protection Act of 2006, benefiting millions of Americans. Furthermore, our guest has actively bridged the gap between academic research and real-world applications, serving as a senior academic advisor to prominent financial institutions and fintech companies. So please join me in welcoming this visionary thinker who works to continue to shape the landscape of behavioral economics and financial decision-making. Shlomo, thank you so much for joining us today.
Thank you.
A lot of your work is based around the Save More Tomorrow program, which you've worked with Richard Thaler on. It's widely regarded as one of the most successful nudges. Could you tell us a little bit more about that nudge and how it's helped 25 million Americans increase their retirement savings?
If you think about it, a lot of Americans struggle to save. They want to save. They understand the need, but it's just difficult to actually pay the bills and have anything left. So with that in mind, that people actually want to save more, is just challenging to do so today. We came up with a program which we call Save More Tomorrow, which had several components. One of them is obviously you don't have to do it today. You could do it tomorrow or next year. And that's similar to our kind of exercise plan, right? I mean, a lot of people sign up to the gym in January, and then they kind of forget to go and exercise in February. But it's easier psychologically to think of doing the right things in the future. So we ask people who are struggling to save today, wouldn't you want to do this next year? And the vast majority, 80% of people who could not save today, say that they'd love to do it later on. Now, if you think about the gym, we sign up and then we never ever go to the gym. So we have to solve that as well. And what we did, which is easier in the savings domain versus the gym, we put it on an autopilot. So we can't get someone to virtually put weights in my hand and kind of do biceps, but we could actually get the employer and the record keeper to automatically take money out of your paycheck and put it into your 401k account. That could be on an autopilot, so that there's no need for people to take an action. And in a sense, inertia is working to the benefit of people. Once you signed up, do nothing, we're going to make sure you're going to save more next year. Of course, why next year? You could think of next year as a good point to do it, because there's what Katie Milkman at the University of Pennsylvania called the fresh start effect. It's easier to think about doing the right things at certain points in time, like next year. But we actually found that maybe an even better point in time to make it happen is when people get a pay raise. If you make more money, you don't need to cut your spending to save. You could take, say, half of the pay raise and put that in your 401k plan. And you don't have to feel the pain of losses because you don't have to cut your spending. And that's virtually kind of what we put in place. And to be honest, it was probably more effective and powerful than Richard Thaler and I, when we came with the idea in the mid-90s, actually predicted. In our first case study, which was a manufacturing company in the Midwest, blue-collar employees struggling to pay the bills, they quadrupled their saving rates over the course of 3.5 years. And later on, it was part of the Pension Protection Act. And today, best estimate I have that about 26 million Americans are saving more to more.
The Secure Act, something recently just passed, has tried to take steps that have really taken the advice of what you're pushing forward. And I know that there's some suggestions that you put out there around it. In an ideal world, when you think about it, how would you like to see it put? Do you feel it's sufficient for what should be in place? Is there more that can be done?
I think the great ingredients in Secure 2.0, which is that all new plans would have automatic enrollment, automatic escalation. I still think we could fine-tune a lot of the details. For example, why only new plans? Why not actually have it across the board, across all plans? And then the industry typically creates automatic escalation on an annual basis. But we find out that actually doing it semi-annually works really well. So there's lots of implementation details we could think about. And that's before we start talking about the fact that in the 21st century, we have more data and more machine learning, big data analytics capabilities. And do we really think that a single parent with 3 kids, 5 maxed out credit cards should be automatically enrolled at a 7% default saving rate? Probably not. Which leads me to, if we're willing to accept that people are different, both in terms of their financial circumstances as well as their preferences, then I think it's time to move to the next phase, which is personalized or smart defaults. So maybe you, Todd, will get auto-enrolled at 10%, and maybe I will get auto-enrolled at 4%, and maybe Joe would actually first pay off his debt, and then he will save more. But so we have to start thinking about how do we personalize the path here, because the one-shoe-fits-all was a spectacular starting point where data and science was at the time, but it's now 30 years later. I think we could do better.
Do you know, so you mentioned that semi-annual escalation seems to be working better than annual escalation. Can you just go into that quickly, just on what is it? I mean, I'm sure it's hard to quantify, again, why exactly one versus the other, but is it just more widely accepted by the people who are contributing to these plans?
No, the benefit comes just from the speed. So think about it this way. If I escalate you annually by 1%, it's going to take you 7 years to go from 3 to 10.
Right.
I escalate you every 6 months, it's going to take you half the time. And that's really important in a mobile workforce, because people change jobs. And when they change jobs, it's often the case that they start again from the default rate, which often is just 3%. So we want to make sure you reach 10, 15, whatever rate much faster, because you're going to get kind of those road bumps that's going to slow you down when you normally change jobs. And we want to make sure there's enough time over this journey of 30, 40 years of saving for retirement where your saving rates are high enough. And that's why I think it's important to get there faster. Now you would ask, okay, why not doing it every 3 months or every month? Why don't we escalate every month and we'll get there so much faster? There's, in a sense, a sweet spot. there's a sweet spot with all those kind of details. If you're going to start having people say 15% on day one, maybe more are going to opt out. We know that somewhere around like 11% as an initial weight, more people start opting out. So we need, in a sense, to kind of find a sweet spot for the starting weight, for the speed of escalation, for how much we escalate every 6 months, and all of that stuff. But I think the industry made great progress. It's just that we could do a lot more.
Yeah, and that makes a lot of sense. I mean, when you think about, the power of compounding over time, right? If you're escalating that faster, you're just compounding more dollars over a longer period of time.
I think a big part of the challenge is, though, getting people to put the money into the 401k, obviously, through the nudge that you guys have, suggested and helped drive towards, is one thing. But then once individuals are invested, right? And I know in the wealth management space, at the end of the day, right, behavioral factors play a big component in risk. And we always want to ensure our clients are invested in a way that reflects their risk. But what can behavioral finance really teach us about how we measure risk preferences in the market, right? How can we make sure that portfolios are better fit for, who people aren't as wealth managers, how we understand what that is?
Yeah, so it's a good question, because we know that a lot of people end up buying high and selling low. They kind of feel comfortable going into the market when markets go up, and then as soon as markets sneeze, they sell. And somehow, miraculously, if you look at the flows of individual investors, especially outside 401k plans, they're almost perfect at predicting markets. They'll just buy at the top and sell at the bottom. And by itself is kind of interesting. Some hedge funds actually trade based on that. When they see individuals actually selling, they deliberately buy, because there's some actually ability of individuals to subconsciously predict. But I think a lot of it is because we haven't matched individual investors to portfolios that fit who they are in terms of kind of their ability to deal with uncertainty and losses. So when you think about risk traditionally, as finance professionals would think about it, they'll have things like standard deviation and all sorts of measurements that assume that we hate variability and uncertainty and volatility, whether things go up or down. It's just the movements that we don't like. We like things to be stable. But behaviorally, people don't feel that an investment is risky if the possibilities are going up 30%, going up 50%, going up 100%. They feel this is the best investment in the world. What are they afraid of? They're not afraid of variability. They're afraid of losses. And if there's another investment that's going to make them lose 5%, they're going to feel that's a bad outcome. An investment that can actually go up 30% or 100% is a lot more volatile. They don't feel it this way. And that's the notion of loss aversion. And it virtually talks about the fact that we treat variability differently if it's in the gains domain versus the losses domain. And we have to understand and measure ahead of time how people feel about losses. And unless we measure what we call their loss aversion, there's a very good chance when markets go down that either they're not going to sleep well, or they're not going to sleep well and they're going to sell at the bottom. And none of these are good outcomes. And scientifically, we know how to measure loss aversion. We don't have to use the standard kind of, forgive my language, cover your ass legalese risk tolerance questionnaires. We could measure what really matters, which is how you feel about losses. And then hopefully we could create longer term plans that people will stick to. But that's one component. Equally important is how we communicate results to people. And that's becoming increasingly problematic with kind of smartphones and digital technology, because if we're going to have an app popping up every day that the market is down and telling us how much we lost, it's going to be very difficult for people to focus on the long term. So it's both measuring who they are, making sure the portfolio fits who they are, but also making sure that the communication focuses on the long term. And then people kind of tell me, well, if you're going to show me 30-year projections and the market is up 1%, it's down 2%, it's up 3%, it's down 4%, nothing is going to change. And my point is, this is awesome. This is the point. We want, in a sense, kind of a number numbness here, because there's no reason for an individual investor to even bother to look at how much markets are up and down today, yesterday, tomorrow. It's completely irrelevant. They'd better play with the dog than actually look at the app.
Yeah, it's interesting because we talk about that. We talk about people living their best lives, and it's not about the markets being up and down. It's about, you know, what you value in your life and or values. And what you're saying is something that's resonated with us so profoundly, because prospect theory has formed a strong foundation of how we built our client experience, right? From the investment side to the, you know, the front end of our experience is doing a lot of what you're talking about there, is really trying to understand individual investors' biases, loss aversion particularly, and how that plays into understanding what's a better investment program for them, an investment plan that, you know, they can stick with over the long term. And I think that's really underrated. And you've grown a lot about this over the years, I think, really, because this comes now back to the value of advice. And it comes back to talking about, you know, particularly holistic advice. I know you're a big proponent of that and a big fan of holistic advice. And that's really where financial advice, you know, includes the guidance on debt, you know, insurance, a comprehensive plan. Can you talk about what you've learned about the potential value of holistic advice?
Yeah, I think holistic advice is really important. And we just talked about loss aversion and how people feel about uncertainty. And that is not just investing. If you think about it, it's also insurance choices. And so many Americans are actually underinsured. So when I think about it, people need help with investing, no doubt. But they also need help with managing their debt. They need help with choosing the right insurance. They need help with deciding how much to save. And it's unfortunate, I feel, that over the last few decades, advice in the US focused mostly on investing on kind of alpha, beating the market. And it's unfortunate because it only matters to the wealthy people who have enough assets to worry about the investment returns, whereas most people have more debt than assets. In the US, for example, for every dollar of retirement assets, there are roughly $2 of household debt. So we can't actually just advise people on assets and forget about the big picture. And I was actually kind of wondering, what's the value of holistic advice? Is that really important? Or is most of the value kind of choosing the right investment portfolio? And it's hard generally to quantify because advice often includes trade-offs. So if I have great advice for you on savings and I say, you could buy, do you have kids, by the way, Todd?
Yes, I have 3 kids. Yes. Joe too.
Same here, 3 as well.
Wait, so if I told you, Todd and Joe, I have a great idea for you, my advice is that you save, and you ask me why, I would say, look, if you're gonna deprive your kids, your 3 kids, of ice cream, never buy them ice cream ever again. In 30 years, when they have kids and you're gonna be grandparents, you're gonna be able, with compounding, buy ice cream for 10 grandkids instead of 3 kids now. So here's a great idea, never buy them ice cream. Now, obviously, it's a pretty dumb idea, but it shows you the problem of evaluating advice. Mathematically, yes, you're going to be able to buy more ice cream if you invest the money. But there's a trade-off here, and obviously, you want to buy ice cream for your kids on occasion. So how do we actually decide if the advice is valuable, and how do we put value on it when it's so tricky? So I actually eventually came with this idea, why don't I look just at advice that always makes you better off? It's going to help you buy ice cream for the kids and ice cream for the grandkids. We're actually going to find $100 bills on the sidewalk, as my good friend John Bashir at Harvard University showed in one of his studies. So how does it happen? How does it work? If you think about debt management, there was one point in the US when one third of Americans paid 1/3 too much on their mortgage. These are $100, these are $1,000 bills on the sidewalk, just refinance. And that study was done on people who had the credit to refinance. They could do it. So if you kind of look at that and people who buy health insurance and they buy the wrong health insurance, a lot of lower income Americans lose one bi-weekly paycheck per year for buying a health insurance that is always more expensive, no matter if they're going to get sick or if they're going to stay healthy. And then I added it all up and I said, okay, what if we take the help people need with debt, with savings, with insurance, and we put it all together? How much is it worth? Shockingly, 7% of your paycheck. If you were to actually help people, it's like a 7% pay raise out of nothing. We just created the magic here for them by offering holistic advice. Now, our industry is stuck at kind of thinking about things as basis points. So if you convert it for the median 401k account, 2,400 basis points. That's the value of holistic advice. And I have some disagreement with the regulators in Washington because there's so much focus on advice is too expensive. We need to make sure that I actually think the issue is not that advice is expensive, that A, we're not offering the right advice, and holistic advice has the value, and B, that what's expensive is the lack of advice, the fact that most people don't get the advice. And I apologize, this is kind of becoming a long lecture, but I want to throw in one more thing about advice.
Please.
There's a lot of discussion about financial well-being because money is just numbers on a piece of paper, but the question is, are you sleeping well? Do you feel, do you have the peace of mind, the financial peace of mind you would like? It's not just the numbers, it's like virtually your happiness, your well-being. So I took the financial wellness score that my good friend John Lynch at the University of Colorado developed. And I kind of started to look, what makes it go up or down? And I looked at men versus women, high income, low income, young, old, all those kind of things. And turns out that there's not much that affects it other than really income. And obviously people who make more money have greater financial peace of mind. But then I actually included one question, whether you get financial advice or not. That was actually the most important aspect of financial well-being. And to quantify it, having financial advice was as valuable as getting a pay raise of 82%. In other words, if you have a choice between doubling your income and getting financial advice, both would have virtually the same impact on your financial peace of mind. And to me, that's a big thing that Washington is missing. It's not so much how much advice costs. The expensive mistake is not figuring out how can we get better advice, more holistic advice to more people. That is the opportunity, in my opinion, to really help Americans and all Americans, not just those who, you know, have a private banker at, call it Goldman Sachs or whatever, just picking an example.
And I think this opens up the door to a very interesting conversation that you just published a big column with the Wall Street Journal, talk about the impact of AI on financial advice, right? Can you talk about where you think AI is ready to be used by advisors, right? And where you still think it needs to be fixed?
So the funny thing is when I talk to advisors, they often tell me ChatGPT, and obviously AI is much broader than ChatGPT, but that's kind of the topic of the day. ChatGPT would do all these fancy models and math, but it will never replace us because we got the human touch. It turns out that it's actually pretty much flipped. It's all wrong. There's a reason why ChatGPT is called Chat. It's not called Advice GPT. It's not called Financial Engines GPT. It's called Chat GPT because it's really good at chatting. It's really good actually at the human aspect of things. And it's actually horrible at math. So studies in the medical domain were kind of experts, doctors, and technology, artificial intelligence, been kind of working together and experimenting, both in terms of the quality of advice, as well as in terms of kind of the delivery, the human aspect, communicating it. And the studies generally find that things like ChatGPT are often 10 times more empathetic with patients than actual doctors. So if you think about it, that's an opportunity. If you think about advisors, financial advisors, they can't call every client when markets go down. But ChatGPT can talk to all of them when markets go down 24/7. On the flip side, actually, ChatGPT cannot calculate even basic math that my daughter can, like 12 times 23 times 34. It gets those kind of things wrong. And when you tell it you got it wrong, try again, it gives you a different answer, wrong again. So actually, ChatGPT needs a lot of help with kind of the financial engineering, but where it can really excel is the human aspect. And in a sense, it can make humans more humans. And when I think about the future, I think very much like the medical domain, we're going to get a hybrid approach. We're going to take what AI does well, and we're going to combine that with whatever advisors are going to do well. And that's going to enable us to do two things. One, which I think people often miss, it's going to help us actually create better advice. Because if you think about most financial advisors, and maybe it's not your practice, but most provide very narrow advice on things they're comfortable talking about. And they forget about everything else that affects the financial lives of people. ChatGPT could have a checklist and help expand it. We can actually give more holistic, better advice, but we could also help advisors go down market because of the technology and service more people. So some advisors tell me they're scared they're going to lose their jobs because technology and AI would replace them. And my analogy is autopilots make the flight safer. The pilots can take a break, rest, be kind of more awake and alert as they land the plane, or as they kind of encounter a very unusual circumstance that the autopilot is not built for. It didn't get them out of business. They're working together to make the flight safer and smoother. And I think that's where we're gonna end up. Advisors are not gonna lose their jobs. They're just gonna be able to provide more holistic, better advice to more people. And I think that is really exciting. Now, are we there? Not yet. There's still things that need to be fixed. But I think the speed of innovation is such that it's not going to take long till we're going to see more and more advisors using that technology and other technologies. Because if you think about markets going down, we do need machine learning and some AI and some big data to guess who's likely to get nervous and sell at the bottom. So in a sense, you have a lot of clients, you can't call all of them. ChatGPT might be able to handle most of those quote unquote calls or chats. But with the right machine learning and AI, we could also say, Todd, these are the 10 clients that you should really call because A, we learn that they're likely to sell at the bottom, and B, we learn that they prefer to talk to a human and not comfortable with the technology, which brings me to another reason why we're not going to have pure AI advisors right away. There's something we call algorithm aversion. Even if the machine is better than humans at looking at brain scans, and we know the machine is better. We actually know that the machine can look at brain scans and MRIs and do a great job, often much better than humans. I bet you, Todd and Joe, you're not going to allow the machine to say, you need a brain surgery, let's go do it, right? And I think this algorithm aversion is going to be there for a while. And I think advisors and technology would just learn how to work better together. And there's a lot of differences. Some advisors are going to grab it quickly. They're going to lead the pack. Maybe that's what you guys are already doing. And some advisors are going to take them longer. They're not going to be as comfortable. And I think that's going to be the key difference between those who are going to succeed professionally, but also be able to really help more clients versus those who would not.
Yeah. I think you make some excellent points, right? The advisors who integrate AI, and I just don't think it's advisors, right? It's across industries. The industries that embrace AI and the individuals who do that, I think are going to, advance at a much faster pace than we've seen in the past. And to your point about algorithm aversion, as two guys who design algorithms for a living, we can attest to that firsthand. And it's amazing, Shlomo, how people hold algorithms to almost a perfect standard, right? They compare it to perfections, whereas humans, there's this lack of expectation to be perfect. But even though the algorithm is more accurate than the human, they still look at it as flawed if it's anything short of perfect. And we've seen that happen so many times when we talk to individuals about it and we look at it.
I mean, you're raising a really good point, Todd, that the threshold, the bar we set for algorithms and AI versus humans is different. And I think about it intuitively as kind of those self-driving cars. I see a lot of them now in Santa Monica driving around. And I think about it, if I knew that the self-driving car is slightly better than me driving, would I accept that offer? Absolutely not. well, it's slightly better. Why wouldn't I accept it? Well, what if it gets me into an accident? Even though it's less likely than me. And the threshold, I think, that most of us would actually apply here is like the self-driving car has to be perfect or almost perfect. If it cuts accidents by half, it's not even good to think about. It's like we're going to dismiss it. It's still going to have so many accidents. And I think that's a good point, because I think it's going to take a while for AI to replace advisors, but in the meantime, there's so many opportunities to help more individuals. I think in the US, only about 25% of households claim that they talk to an advisor, but even then, it's not clear how holistic the advice is. So the vast majority of people don't get advice, and unfortunately, it's probably the people who need the advice the most, because they have less resources, and any money mistake would have a bigger impact on their financial lives than those who actually have more resources. And if they make a mistake, they just have a little bit less, but it's not going to have the same emotional impact on their lives.
I think as an advisor community, we need to look more at more ways about how we can bring that advice to more people. Maybe AI is a way to be able to do that, but it's certainly something we as as a professional organization and group have to really look at much deeper. We've embraced it at a level that you're talking about. Understanding people on the front end is something that we have spent so much time and energy and working with technology companies around the globe to really, how we understand people more up front to make that back end experience much better, because that's been our point for a long time, Shlomo. There's obviously alpha that can be generated, but it's only as good as people sticking with a plan and then how that is all generated around them. So it needs to be more focused on the individual and the person on the other end, because they don't stick with it. It's, doesn't matter how much alpha you generate, right? In the long term, no one's going to be there. They get that. So I just want to close it up for you if we could. Shlomo, thank you so much for being here today. I really appreciate it. Today's conversation has really been enriched by the presence of such a luminary in really the field of behavioral economics and finance. And your groundbreaking contributions have not only reshaped the understanding of human behavior, but really have also translated into practical, solutions that empower individuals to make informed financial decisions. And as we reflect upon the profound impact of your research and the collaborative initiatives that you push forward, it really becomes evident that your unwavering commitment to enhancing financial well-being exemplifies the highest standard of academic and practical excellence. So I extend my sincerest appreciation and our esteemed, gratitude really for you being here and sharing your invaluable insights. Really on behalf of Sycon Capital and our audience, we eagerly anticipate witnessing, continued influence, your pioneering efforts, for years forward. And hopefully we can circle back and have this conversation and see the evolution of how AI is maybe affect the wealth management experience for everybody. But thank you so much. I appreciate it. And best of luck with everything that you're working on.
Thank you, guys. Bye-bye.
Thank you,
Bye.
Shlomo.